Now, just a little bit of background. Firstly, I'm just going to show, got to get my English version. What are pensions in Australia? Firstly, a definition term. We don't use the word pension. We use the word superannuation, and because that's too long for most Australians, we just use the word super. So throughout this presentation, it may slip from me and I use the word super. I'm talking about pensions, Pillar 2 and Pillar 3 pensions. It's exactly the same thing. And it's huge. So today, the total number of assets in the pension system is $1.4 trillion. And here, $1 Australian is roughly $1 US. So just count them at parity, 1 to 1, it's the easiest. So 42 trillion rubles. It's growing strongly. So it used to be 60% of GDP. It's now at 100% of GDP. And in the next 10, 15 years, it's probably going to be at 130%. And the reason is that you have mandated growth. So 9% minimum growth every year. In fact, it's more like 12 is going into the pension system. And once you get a big enough pot, that kind of annual growth is obviously pushing volumes. And here we can see what that means to household wealth. So most of the Australian household wealth is actually in their homes or in land. It's quite a large percentage. So you can see here 60%. The next biggest by far is super. It's pensions. And it's a huge part of the financial assets. So if you look at 20% of total household assets, when you get that down into superannuation, it's more than 60% of household assets, of financial assets. So I think what is clear here is that Australians understand that this is a financial asset. If you look at in Russia, most people would know the value of their home or their apartment. Most people would know how much money they have in the bank on deposits. They might know how big their brokerage account is at the bank. How many of you know how big your pension pot is? Is there anyone who can quantify that? And therefore, can you consider this as a financial asset when you can plan? I don't think there'd be many people here who say, yes, my pension pot is worth X. Without that, you can't consider it as a financial asset. People find it very, very difficult to plan. And that's not the case after 15 years of pension reform in Australia. Today, everybody, I could tell you, I can look online and I can tell you versus all my other assets where my pension pot is standing. And it's mine. It has a figure on it. And therefore, it's part of the planning process. So today we'll cover, firstly, just a few slides to show Australia in the context of the top 10 countries in the world of pensions. We'll then go into the various pillars that we have, pillar 1 to 3, very similar to Russia. We're going to look then at how it actually works. So who are the participants in this market? Where's the economics in the market? Where are the investments and how it works? A little bit of how it's regulated, and then finally the impact on the economy and where it's going forward. So just some key facts. You can see here the major pension markets. You have the US, you have Japan, the UK, Australia, Canada, and so forth. This is the size of the pension assets in the year 2000. Then we go to the year 2010. And you can see the growth. So in 2010, what percentage of GDP, and then what is the growth rate over the last 10 years. This is on a dollar basis. On a US dollar basis, Australia next to South Africa and Brazil is one of the fastest growing markets because of this, a very strong regulatory framework for pensions. But I don't want to, we all know that many currencies have also appreciated against the dollar, so we should look at the same comparison in local currencies. But here again, you can still see Australia has an extremely high growth rate, even in local currency, next to South Africa, of pensions. So it's a fact, it's growing strongly and it's large. Now, where does a lot of this money go? Pensions, because they're considered very long-term money, you don't have a 1, 2, 3-year horizon, you have a 20, 30-year horizon in these pension pots. So there's very much a strong focus on equities, up to half in general. And within those equities, you'll see also more than half tends to have a home bias. So a large pot of money which is going into your own equity markets, where people are participating and benefiting from growth in the home economy. Likewise, on fixed income here, you tend to see much higher home bias. We are seeing, particularly in more recent years, due to the volatility and the challenging economic circumstances, much more investment in fixed income, but yeah, it's all very high. Overall, in asset allocation, you see here, this is what we were just mentioning, so around half will be in equities. Australia is relatively small in fixed income, and you see increasing amounts go into what we call other. And here, this is really where domestic investors participate in infrastructure and property funds that are on offer in the market. One of the reasons that this market gets very high scores on sustainability is here. It's this defined benefit versus defined contribution. It's extremely low in Australia in terms of defined benefit. And much of this predates pension reform that happened 15 years ago. And almost all of it is in the public sector. So this 19% is also pretty close to the share of public sector pension funds. In the non-public sector, so really all of the private sector where the bulk of the economy is, you have accumulation schemes. You do not have defined benefit where your pension is linked to your years working and your final salary. It simply doesn't exist. The way that has been looked at to address even this unfunded shortfall, most defined benefit programs, there is the risk of a shortfall, and we are seeing that, was the creation of the Future Fund. I'm not sure that many of you will be aware of the Future Fund. It was actually seeded by the government through the sale of Telstra, which was the national phone company, and it was formed in 2006. So it's relatively new, but by now it's one of the top sovereign wealth funds in the world. It has about 75 billion in it, and there's rules around the use of this. It's solely there to pay for unfunded public sector pensions. So it's there to pay for this. And the government cannot access it before 2020 or at the point these unfunded pensions have been covered. So at the point you have full funding, then the fund can open up for distribution. Now just a few statistics about the two markets we have in Australia and Russia, just to put it in context. You can see average income around 56,000 per annum. You see the contribution of GDP for pension payments from the state. Life expectancy, population is very small next to Russia. It's only 22 million people. The workforce is also very small, at about just under 12. And I think regardless of that, the issues we face at retirement are the same. So is it really a golden opportunity to enjoy ourselves, we don't have to work anymore? Or is it a nightmare? Do I have enough in my pension pot? How much am I going to spend? Will the income I have exceed the inflationary aspect on my costs? And I think for many pensioners, there's questions around how do you survive in your old age? So certainly what people want is independence in retirement. I think most people would want that. You don't want to be relying on a state payout which could change at any time. We want pretty low volatility in our income when we're old, and we also want enough to pay for emergencies, sudden hospitalisation, helping out family members and so on. So the principle of the Australian system has really been, how do you have a system that is sustainable, that is helping economic growth, and is not necessarily a drag on the state coffers. And that's the basics of how it came about. So what we have is the Pillar 1, this is really pay as you go. The pensioners under an age pension, and this is funded out of current tax receipts. So very, very similar to around the world. The age pension is not designed to give people a fantastic quality of life. So certainly it's been introduced in Australia since 1909, a long time ago, and it's always been looked at as a way to cover basic costs. And it's been linked to the average weekly earnings of your average male. So if your average weekly earnings of a male in Australia are $100, the age pension aims to cover around 25% of that. And over the last 100 years, that's been consistent between 20 and 25%. Now the amount paid differs. Certainly in 1909, at 20%, you were receiving $1 a week. Very different today, of course, but the principle has stayed fairly similar. Pillar 2, this is what we call superannuation guarantee, and I'll talk about the guarantee soon. This is a mandatory deduction of 9% of your wages, and it's taken by your employer. And here, the definition of employer is very, very wide. It applies to everybody earning more than $450 a month, and it applies to everybody who is between the age of 18 and 70. Which means it includes part-time work, it includes casual work, it includes people who may be on contract, but they're solely contracted to you. They can even have their own business number, their own company, but if you are their sole client and you're paying them by an hour, you have a legal responsibility to contribute towards their super. So it's very, very wide-ranging. And then you have Pillar 3, which is the voluntary, on top. Now, how does Pillar 1 work? We'll do this very, very briefly because it's not really the scope of the presentation. So it's really just a safety net. It allows pensioners to survive and to manage their bills. There's a lot of assistance as well on pharmaceutical and healthcare and so on. It is subject to a means test. Now, Australia has never had an earnings-related insurance component. You never have 30 or 40% of your final salary, and you don't necessarily have a flat age pension. It's means tested. It's only there for people who need it. So if you're earning a relatively good income from your personal savings, if you have a lot of investment property and other interests, your age pension will be zero. Likewise, if you haven't saved very well, if you are in the low income group, for whatever reason, the age pension will go up to 100%. So the age to access this is 65. Like many countries, it is increasing. That's been the case since the last 100 years. So the push as life expectancy increases is to increase the age at which you can also get an age pension. And today, there's many, many Australians getting a full pension. It's 56%, and that's because pension reform only really happened 15 to 20 years ago. So we will expect that to come down in future years. And here's just it's really for your reference, but it shows you the means testing. So if you're a single person, your full pension would be paid by the government, which is nearly $18,000 a year. But to get the full amount, you have to, if you own your own home, you have to have not other assets which are $186,000 or less, and you have to be earning less than this amount in terms of income and interest. If you fulfill both of those criteria, you get the full pension. If, however, you actually have more assets, then your pension starts to decrease proportionally until it's cut altogether. So very much a means-tested system. Pillar 3, on the other hand, is very much driven by tax. This has been in place for many, many years. In fact, Pillar 3 was more prevalent than Pillar 2 for years in Australia. It's encouraged through tax concessions. It's not as relevant, I guess, in Russia, where income tax is relatively low at 13%. In contrast, in Australia, the top rate of tax is 46.5%, and pension payments attract a rate closer to 13%. So in Australia, it's a flat rate tax of 15% on contributions into your super. So really, this extra voluntary top-up in many ways is driven by tax considerations. Now, the second pillar, how did it come about? So prior to the 80s, superannuation of pensions was really for the privileged few. So what we call the white-collar workers, so the office workers or workers in large corporates, managers, who were offered a little bit of pension payments as an employment perk. You also had some pensions for the defence forces and other selected groups. That, together with private savings, was basically your pension system, so almost non-existent. Now, what happened in the mid-80s was that the trade unions got together and were pushing for more pay rises. They wanted a 3% pay rise. The government was not too keen to give that because of the time inflation concerns. So a nice idea was, don't pay us 3% in salary, but put that 3% into a regulated pension fund. And everyone was happy. And that was actually the first step, the baby step, to institutionalise pensions in Australia. And you started to see more and more unions and more collective work groups opt to get payment into a pension scheme rather than a wage rise. Now, in the early 90s, the trade unions went back to the government and said, we'd like another 3%, please. We'd like 6% by then into pension pots. The government agreed, and then they took that proposal to the Industrial Relations Committee. Now, this is a government body in Australia very much that sets the labour code. It sets the terms for employment, for dismissal, and so forth. And at this point, they said, well, actually, compliance is quite poor. If an employer doesn't want to pay the 3%, it's a very lengthy court process to get the money. We're not really covering part-time workers, so perhaps instead of just saying yes to this, we should set up a conference. Let's just talk about it a little bit more. And at this point, the Australian government turned around, and I think this is a very bold move. They said, actually, we're going to scrap that whole idea we just supported, and we're going to implement a Pillar 2 superannuation guarantee for every Australian. And that's really a watershed mark. I'll be interested to hear how they translate watershed. Watershed is a time, if you look at the literal meaning of the word, it's where a river splits and it goes in two different paths that never intersect again. When you use it in a figurative way, it means a moment when something changes and it will never be the same again. This was a watershed moment for the Australian pension system because it meant that every single Australian was about to get a pension. It was about to be very heavily regulated, and that compliance would be assured. And the compliance comes through what we call the superannuation guarantee. Now, this is not a guarantee on returns. The guarantee is that your employer will pay it. And this is tracked with the tax department. All superannuation payments are tax deductible. But if you've missed a payment or you're late, it's not tax deductible anymore. You have to then pay a guarantee levy. So that money, if I give you an example, if I'm managing Gazprom, and I'm supposed to put 1 million in quarterly pension payments for my staff into their designated pension funds. If I miss that, if I just decide actually I don't have the cash flow this quarter, or for whatever reason I'm late, at that point the tax office steps in. I have to pay that 1 million on a non-tax deductible basis to the tax office. I also have to pay 10% annual interest for every day I delay to do that, and I have to pay an admin fee. So for every employee that is affected, plus as a general admin fee for the tax office to do the service to collect the money, I'm penalised. So you can imagine that instead of having a tax deductible expense, you have a non-tax deductible expense and a lot of fines from the tax office. It starts to have a very high rate of compliance. And this is what we call the guarantee levy. It's legislated in the law and there's an extremely high compliance with payment. That started off at 3% when the government implemented this in 1992. Over the next 10 years it was raised to 9%, and now it's going to go up to 12%. Now, the motivation for super in Australia, there's twofold. The first is what we covered at the very start of the presentation. It is a financial asset. Everybody knows how much they have, and it's considered as part of your financial assets. So much so, for example, if you're getting divorced and you need to split your assets with your wife, your super is part of the equation. It's a tangible asset. The second part of the motivation is really around tax. So certainly, as I mentioned, you attract a much lower level of tax when you put money into the system, and therefore it's certainly it's attracting a lot of those flows. That tax rate only goes up to a certain amount. Now what you don't want is that people can just flood their pensions pots at a preferential tax treatment, because if you don't have a cap on that, you're diminishing your ownership in other assets, you're diminishing your consumption and your spending. So there is a certain limit for people up to 50 that they can contribute at the preferential tax rate. Once you're getting closer to your pensionable age, between 50 and 65, the limit goes up. And this is, we'll spend a little bit of time on this slide because I wanted to explain exactly how the system is working. So we won't talk about the Russian system, you're all very, very familiar with it, much more than I am. But we will just focus here. Here you have the workers and the employers. So this is the mandatory aspect, so the 9% up to the ceiling goes into the pension fund of your choice. Likewise, any voluntary top-ups go into the same pension fund. So there's no distinction between Pillar 2 and Pillar 3, it goes to the same place. Now, a pension fund, a superannuation fund acts as a trust. And the trustee has, therefore, its responsibility for the prudential operation of the trust, which is really around the operation of the funds, formulating good investment options, diversification, and so forth. But there is no direct management of money. It's purely a trust function. And the management of money is then going out to professional money managers. And this can be either via mandates, if you have fairly large assets, it might go directly into segregated mandates or trust mandates like we have here in Russia. It can also go into mutual funds. So if you want to give a lot of choice to your members, they can go into mutual funds. And we'll explain the difference between the two. But essentially, 100% of the money that is for your pensions is going into this pension fund, which is offering an awful lot of different investment options. And it is also offering insurance. Not many people in Australia would buy life insurance outside of the pension system. Why would you pay 46% tax and buy your insurance premium out of that heavily taxed money? So what you tend to have here is the lightly taxed money and all of the life insurance will be within your pension pot. So it's an extra cost on your pension, but it's wrapped up the market. That's where your life insurance market sits. Then that accumulates every year, it grows. You're absolutely free to change your allocation. If I decide I want to go, I'm not so positive on Australian small caps, I can very easily change that to global fixed income or any other asset allocation. So throughout the life of the pension fund, complete freedom and flexibility to do as I wish. And at retirement age, I can receive a lump sum, or I can buy an annuity from an insurance company. So it's a very simple system. And really, how does it work? I've just brought some practical examples so you can see. When I'm joining a new company, these are the forms. There's no way you can change these forms. The regulator simply has them. So it's very, very basic English. How do I choose my super fund? And there's 2 pieces of paper, and that's all you need. So one, this is for the employee. And here I say to the employer, what's my super fund? So which one am I in? All everything that's available on the market, and what's their bank details. Then I have the employer form, which is really the employer details, and the records of which from when they commence paying. And that's it. That's the full paperwork. You also tend to, most employers will then, if you're offering a corporate plan, they'll give you a little bit more information on the corporate plan. And after that, your pension fund contacts you. It requests you to say, what is your asset allocation? And after that, you'll get statements every 6 months. Now, I've got an example here from a pension fund in Australia called Plum, which I used to always think was a really stupid name. But now I see companies like Apple and Orange doing very well, so I've had to change my mind on the word Plum superannuation fund. But this is a classic benefit statement. As I said, it's a financial asset. It's like a bank statement. And what I'll see here is who I'm working for, what the contributions have been, so I can check that my employer is paying. I see all the fees. I see the level of my insurance benefit, all the expenses aside from the usual fees, so the underlying asset management fees. I see what the trustee is charging me, everything is in there. Then I see my underlying asset allocation, how it's performing. I see my asset allocation. And then there's still a lot of examples of all the other choices that this pension fund offers and how they've been performing. So every 6 months you get a very comprehensive view of what has happened to your money. And this is an example of a very simple fund. So you simply have the trustee